Hello, I'm Angeline Ong, and welcome to Beat the Street, the show that gives you all the tradable news ahead of the Wall Street Open. Coming up, US stocks investors cautiously optimistic on that Fed rate cut expected next year as they brace for more jobs data. Nvidia has unveiled plans to develop new chips compliant with US curbs. Gold ahead of more jobs numbers. Gold prices firm on yields weakness as the focus turns to US jobs data. But do technicals tell a different story? Well, we'll be joined by IG's Axel Rudolph in just a moment. First of all, good afternoon and a warm welcome to you to this new edition of Beat the Street. Now, not long now before Wall Street starts trading, just having a quick look at Wall Street here, which mirrors the Dow Jones Industrials. And I can tell you that US stock indexes have extended gains just ever so slightly after the November ADP employment data. For more on that, let's just cross over to Chris Vecchio, who joins us now live from New York. Chris is from Tasty Life, part of IG Group. Chris, what do you make of the numbers? Some early thoughts from you?
The November ADP jobs report came in at 103,000 versus 113K expected. And it's part of a continuing trend where it appears that the U.S. labor market is ever so slightly weakening. One of the big numbers that's been standing out to me over the past few weeks has been the fact that continuing jobless claims are now 24% higher than where they were a year ago. Every time in U.S. history, as far as the data series goes back, which is to 1968, whenever continuing claims have risen by at least 20% over the past year, we've seen that we've been in the middle of or at the start of a recession. And so the jobs market is beginning to feel the weight of the Federal Reserve's rate hike cycle. We're 500 basis points plus into that rate hike cycle, a rate hike cycle that looks like it's now finished. But it does take time for those hikes to make their way through the system. The Federal Reserve's own research say that it's 12 to 18 months before the hikes are fully digested. And with the last hike having come in July of this year, that means we really won't feel them all perhaps until January 2025. So the labor market right now is on a trajectory to get weaker. How much weaker, we do not know. We do see that from the JOLTS job reports. The job openings in the country have now fallen to 8.733 million. The available jobs per available worker right now is at 1.3, which is the lowest level that we've seen effectively since the start of the pandemic. There's clearly some compression here. All in all, it's a sign that we won't need to hear anything more from the Fed when they meet next week. And more importantly, it does increase the odds that we will get the first rate cut from the Federal Reserve in March 2024.
Now, Chris, does this all mean that the heavy lifting has pretty much been done by, the Fed early on, and perhaps they won't have to cut rates early next year? Do you think that this might be the case?
With the last rate hike having come in July, it would be spot on the nose in terms of historical averages for the Fed to begin their cutting cycle in March. That's 8 months apart. In fact, throughout history, it's been 8 months on average between the final hike and the first cut. Inflation is coming down very rapidly here. And if we're seeing that the available pool of job openings is shrinking while unemployed persons and people staying in the unemployment line are going up, that means wage pressure should be coming down as well. Fed economists, after all, are Phillips curve economic theorists. They believe that there's a link between the labor market and inflation. And so as the labor market weakens, it brings down inflation pressures. And those inflation pressures already appear set to roll over, particularly at the start of 2024. So as far as I'm concerned, the Fed is done. We're going to begin to hear more about a rate cut cycle soon. That may be good news right now for stocks in the very short term. The window between the end of the hike cycle and the beginning of the cut cycle tends to be that Goldilocks window. But once the cuts begin and the way that the data has been evolving, I'm not sure that a continued pulling forward of those rate cut expectations will be seen as a good thing for stocks, because after all, the Fed will not be cutting rates because it's defeated inflation. They'll be cutting rates because the economy actually needs it and is in a bit of a state of, we'll say, disarray.
Interesting stuff. I'm sure we'll be checking in with you for more on that. And what's also fascinating about this is I was just looking at some data points the other day that showed that potentially, as you say, the short term, it's good for stocks, but then longer term, we could see stocks falling if these cuts start coming through. Now, just turning our attention to the banking sector, the collapse of Silicon Valley Bank, and 2 other lenders still in regulators' minds, and they are contemplating imposing capital hikes and other new regulations on the whole sector. Top bosses of JP Morgan, Morgan Stanley, Goldman Sachs, and other major banks plan to warn the Senate Banking Committee that this has hurt credit markets and the broader economy. Now, we're also watching out to any reaction for the Canadian dollar a little later in the session. Just checking on the dollar versus the Canadian dollar cross there ahead of that. The Bank of Canada should keep its overnight rate at 5%, leaving borrowing costs at 22-year highs. This is the expectations. The Bank of Canada last held its prime rate on October 25th. And said it was dependent on inflationary risks. The Bank of Canada has always said it would not hesitate to move rates higher if it deemed it was necessary. But there is very little risk at the moment. Headline CPI coming in at 3.1% in October. Inflation still seen returning to the 2% target in 2025. However, the central bank says it expects inflation to be higher in the short term and projects inflation will average around 3.5% through the middle of 2024. Now, turning to individual stocks, I just want to show you Nvidia because its shares are all sessions on the IG platform. There you go. And also they are moving. Let's just have a look at that there for you. It's now up around 0.5%. Nvidia unveiling plans that it's going to make chips that are compliant with US curbs. Now, why this is so interesting is because, of course, the chip maker has been hit by these announcement of curbs and government export restrictions by the US. This is the export of AI chips to China. Also, the data point that I want to underline is that Nvidia holds more than 90%, that's right, 90% of China's $7 billion AI chip market. Nvidia's shares are currently up 0.5%. Also, to another story that we are following for you, Exxon Mobil has upped its production forecast for 2024 as it bets on a lift from the Permian Basin and Guyana. It sees production of 3.8 million barrels of oil equivalent per day in 2024. Just bring up Exxon's chart for you because ExxonMobil also all sessions on the IG platform. This means you can trade this now and not have to wait till the cash session is open. Exxon says it expected output to be flat until the end of this year at 3.7 million barrels per day due to its exit from Russia. ExxonMobil increases its annual project spending to between $22 billion and $27 billion through 2027. It's also increasing the pace of share repurchases to $20 billion per year from the closing of its Pioneer deal through 2025. And it expects $6 billion in additional cost savings by 2027. Now, British American Tobacco has announced this morning it would take a hit of around $31.5 billion as it writes down the value of some of its US cigarette brands. BATS's move comes as ever stricter regulation and growing awareness of health risks squeeze tobacco companies' traditional business. Many of these companies have been looking to diversify into what they call non-tobacco products or seen as healthier, such as vapes and also tobacco burning or heating products. However, it has to be said that these two have started coming under the radar of regulators. It's also pointed to economic challenges in the US where some inflation-wary consumers are downgrading to cheaper tobacco brands. BAT CEO Tadeu Marroco believes it is no longer possible to justify an indefinite value for those brands, equating to around $80 billion on BAT's balance sheet. Hence the $31.5 billion non-cash adjusting impairment charge. BAT shares, as you can see here, tumbled in London. Let's see what the damage is. Down more than 8%. And Imperial Brands and Philip Morris also feeling the heat. Now, in a note published earlier this morning, Morgan Stanley has expressed its doubts on the hydrogen industry. According to Morgan Stanley, the industry environment for clean hydrogen is set to remain uncertain in 2024. Unfavorable economics and slow adoption being the main hurdles, it says. Just showing you Plug Power here, which is all sessions. Morgan Stanley downgraded a couple of stocks. One of them is this one, Plug Power, an all sessions stock on the IG platform. Morgan Stanley cut the stock to underweight from equal weight, citing liquidity concerns and worsening hydrogen economics. Now, moving on to commodities, I just want to show you gold, because gold has had a fascinating move recently. As you can see there, if I come out away from this chart, you can see that it has moved lower from that level, that 2135 level that was hit earlier on in the week on elevated bets for a Fed rate cut. However, it has slipped from there and come down lower. So is the gold rush running out of steam? Well, IG's Axel Rudolph has been looking at the technicals.
Well, it certainly looks like it, Angeline. If you look at the daily chart, what we saw on Monday was this huge gap higher to a new all-time record high at above $2,100 per troy ounce before we formed this bearish engulfing pattern, where basically you've got the body of this candle engulfing the previous day's body, which is in this case last Friday's candle here. And that is actually quite negative short term, and did lead so far to a slide back to the late October, and also the 21st of November highs between $2,009 and $2,007 per troy ounce. And that, together with the October to December uptrend line, has so far held the gold price around $2,010. So we're testing important technical support here short term. But since we had this bearish engulfing pattern, I wouldn't be surprised that over the next few days into the year end, we'll see some sideways trading around the psychological 2000 mark. And I don't think we will take out this recent high before the first quarter of next year, perhaps. So short term, yes, consolidation in place, but basically from a longer term trend perspective, provided we stay above, as you can see here, the red line and the orange line, which is the 200 and the 55-day simple moving average, and more importantly also the November low at $1,932, further upside is likely to be seen on a medium-term basis, but short-term we should probably see some sideways consolidation around the 2000 level.
Now, yet another session of losses for oil. It seems difficult for WTI and for Brent to find support lately. Markets doubtful of the effectiveness of OPEC Plus supply cuts, and traders also increasingly concerned by a worsening demand outlook in China. API data did not provide any clues yesterday evening as stockpiles rose across the board. Crude oil stock increased by nearly 600,000 barrels. Gasoline stocks went up by 2.8 million barrels, and distillates by nearly 900,000 barrels. Now, before we go, just a quick reminder of how that ADP employment data affected markets, and US stocks overall extended gains ever so slightly after that November ADP employment reading. Well, that's it for this edition of Beat the Street, the show that follows all the trading action, helping you position yourself ahead of the opening bell. For more trading insight, follow me on @Angeline Ong on Twitter. This is IGTV.